In October of 1929, a man named John D. Rockefeller Sr., at that point the richest person in American history, worth roughly $400 billion in today's money, did something that confused almost everyone watching. The stock market had just crashed, banks were failing, factories were shutting down, millions of ordinary Americans were losing their savings, their jobs, and in some cases their homes. Breadlines were forming in the streets of New York City, and John D. Rockefeller walked into the market and started buying. He reportedly told reporters at the time, "These are the days that try men's souls. My son and I have for some days been purchasing sound common stocks." That statement, made publicly during the worst financial panic in modern American history, was not a flex. It was not a PR stunt. It was an honest description of the single most important truth about how generational wealth is actually built, and most people missed it entirely because they were too busy panicking. Here is the truth that Rockefeller understood and that does not appear in any personal finance article written for a general audience. Economic crashes do not destroy wealth. They transfer it. The money that disappears from your brokerage account does not evaporate into the atmosphere. It moves. It flows from the people who had to sell, because they were scared or leveraged or unemployed, into the accounts of the people who had prepared to buy. A Reddit commenter put it with the kind of directness that makes finance commentators uncomfortable. Crashes don't destroy wealth, they transfer it. From weak hands to strong hands. The question is always which pair of hands you're sitting in. That is the whole video in one sentence. Everything that follows is the explanation of how the transfer actually works, which specific assets the wealthy accumulate before it happens, and, most importantly, what any ordinary person with a plan and some patience can do to end up on the right side of that transfer. Because the strategy is not secret. It is not locked behind a private wealth management desk or a Bloomberg terminal. It is hiding in plain sight in the history of every major economic downturn since the Great Depression. And most people will never act on it, not because they do not know it, but because knowing it and believing it when the panic is loudest are completely different things. Where the money actually goes. The question everyone gets wrong. Let us start with the most fundamental misunderstanding about market crashes, because if you do not understand this, everything that follows will not make sense. When markets crash and the news reports that trillions of dollars have been wiped out, people picture something like a giant economic furnace, wealth being fed into it and converted to ash. The S&P 500 falls 40%. $2 trillion of market value disappears. Where did it go? The honest answer, the one that Reddit's Explain Like I'm 5 community actually nailed more accurately than most financial journalists, is that most of it was never real money in the first place. It was a collective agreement about what something was worth. Imagine you have a baseball card worth $100. The market crashes. Now everyone agrees it's worth $10. The $90 didn't go anywhere. It was just an agreement about value that changed. Nobody physically has that $90. That explanation is technically correct for the paper losses. The decline in asset prices that exists on a screen rather than in a physical transaction. But the story gets much more interesting when real transactions happen. Because when someone actually sells in a panic, when they convert that falling asset back into cash, the money does not vanish. It goes to whoever bought it from them. And the people who are positioned to be the buyers when everyone else is selling are, almost without exception, the people who had prepared for exactly this moment. One comment from a Reddit investing thread captured the mechanics precisely. The ultra-rich treat crashes like a controlled burn. They know that temporarily lower asset prices are a sale on the things they were already planning to own forever. The people who lose are the people who bought on margin, the people who needed that money within 2 years, and the people whose fear response overrode their plan. 3 categories of loser in a crash: the leveraged, the short-term holders, and the undisciplined. The wealthy manage to avoid all 3 simultaneously. And the way they do it is through a specific set of asset positions that they build before the crash arrives, not during, and certainly not after. The first asset, cash, but not the way you think about it. The most contrarian thing I am going to say in this entire video is this. The ultra-wealthy do not hold cash because they are afraid of losing money in the market. They hold cash because cash is their offensive weapon. It is not a defensive crouch. It is a loaded gun pointed at every distressed asset sale in the economy. Think about what cash does in a crash that no other asset can do. It does not decline in value when the market falls. It earns interest while everything else is falling. And it can be deployed instantly, at the exact moment when everyone else is desperate to sell and nobody is positioned to buy. Warren Buffett's company, Berkshire Hathaway, held more than $300 billion in cash and short-term treasury bills heading into the market volatility of 2025. The financial press spent years asking why Buffett was not investing that money. He was not investing it because he was waiting for the moment when he could invest it at prices that reflected genuine fear rather than optimism. Cash is the instrument of opportunity, but only if you hold it before you need it. A Reddit thread asking how much cash people were holding ahead of an anticipated crash produced responses that revealed the sharp difference in thinking between the financially prepared and the financially anxious. I hold about 12 to 18 months of expenses in cash or cash equivalents. Not because I think I know when the crash is coming, because when it does come, I do not want to be forced to sell equities at a loss to cover my life. And if it comes with a big enough drawdown, I want to be able to buy. The rich don't hold cash because they're scared. They hold cash because it lets them be greedy when everyone else is scared. That's the entire Buffett quote explained from the other direction. The important nuance here is the form that cash takes. Genuine wealthy investors during a pre-crash positioning period do not stuff money under a mattress or leave it in a checking account earning near zero. They move into short-term government bonds, specifically Treasury bills, which are the safest form of short-term lending to the U.S. government and currently pay meaningful interest while preserving capital completely. This is the distinction between storing cash and deploying cash as an asset class. A Treasury bill that matures in 3 months, paying a 4% annual yield, is not just safety. It is a return on your preparedness while you wait for the opportunity that justified preparing. The practical lesson for an ordinary person is not to liquidate your entire portfolio and go to cash. It is to ask one specific question. If the market fell 40% tomorrow, would you be a buyer or a seller? If your honest answer is seller, because you need the money, because you are leveraged, because the psychological pressure would overwhelm your plan, then you need more cash or cash equivalents before the crash, not after. The second asset, high-quality stocks, bought at the discount window. The second thing that the wealthy buy before and during crashes, and this is the part where most people's intuition completely fails them, is the stock of excellent businesses, not speculative growth stocks, not the companies that went up 500% on a narrative, not the meme stocks, not the unprofitable tech companies that are 6 years from their first dollar of earnings. The fundamentally excellent businesses, the ones that have durable competitive advantages, consistent cash flow, and will still be operating in 20 years regardless of what the economy does in the next 2. John D. Rockefeller's great-grandchildren are still collecting dividends. The companies he bought in 1929 paid those dividends through the Depression, through World War II, through every recession, every crisis, every panic that followed. The crash did not destroy those businesses. It just made their stock temporarily cheaper than it should have been, because the sellers needed cash more than they needed the shares. The Great Depression produced the most documented case study of this phenomenon. A Reddit thread asking who got rich during the Depression and how produced a specific historical inventory worth examining. Joseph Kennedy, yes, JFK's father, shorted the market on the way down, then went long with the proceeds on quality stocks at the bottom. He entered the Depression a millionaire and exited it vastly wealthier. He said later that he knew the crash was coming when his shoeshine boy started giving him stock tips. John Paul Getty started buying stocks aggressively in 1932 at the absolute bottom. At the time, it looked insane. He said he was buying dollar bills for 10 cents. He died as one of the wealthiest men in the world. The shoeshine boy story is the famous one, and it encodes something real about market psychology. When the person shining your shoes is telling you which stock to buy, the market has become disconnected from fundamentals and is running entirely on shared enthusiasm. Shared enthusiasm is not a foundation. It is a crowded room with a single exit. The smart money, the institutional investors, the family offices, the people managing genuinely large pools of capital, watch for specific signals that the enthusiasm has replaced analysis. When those signals appear, they start doing something that feels counterintuitive. They reduce exposure to the most enthusiastic parts of the market and build up positions in the things that will still be valuable regardless of the enthusiasm's direction. What does that look like in practice today? It looks like rotating out of companies whose valuations are based entirely on future growth projections that depend on everything going right, and rotating into companies with pricing power, the ability to raise prices without losing customers, because the product is genuinely necessary. Think utilities. Think essential consumer staples. The companies that make toothpaste, toilet paper, and basic food. During the 2008 financial crisis, Walmart's revenue grew. Dollar stores expanded. The businesses that serve people's non-negotiable needs do not stop being needed when people are frightened. Dividend history. Companies that have paid and grown their dividends through multiple recessions. A dividend payment is a company converting its earnings into cash in your account. It does not require the stock price to go up. It does not require market enthusiasm. It requires the underlying business to remain profitable, which quality businesses tend to do even through downturns. Low or no debt, because companies with heavy debt loads face an additional threat in a recession that profitable companies with clean balance sheets do not. If interest rates rise or credit tightens, a heavily indebted company faces a liquidity crisis that can be existential. A debt-free company with strong cash flow simply waits the downturn out. One comment from a Reddit investing thread on crash preparation distilled the stock selection principle more simply than most investment textbooks manage. During a crash, I want to own things that people still need when they are scared, not things they want when they are optimistic. Those are completely different lists. That distinction, needs versus wants, fear versus optimism, is the organizing principle behind every successful crash-era investment. People stopped buying new iPhones in 2008. They did not stop buying groceries. They stopped eating at restaurants. They did not stop buying generic food at Walmart. The fear economy is a different economy, and the assets that perform in it are different from the assets that perform in the confidence economy. The third asset, real estate. But only at the moment nobody else will touch it. Here is the thing about real estate in a crash that most people get backwards. They spend the boom years being afraid they will miss out. House prices are rising, everyone is buying, and the fear is that if you do not buy now, you will never be able to afford it. And then the crash comes, prices fall, and suddenly everyone is afraid to buy, because who wants to catch a falling knife? What if it goes lower? What if the neighborhood deteriorates? What if the bank fails? The wealthy have been conditioned, through either experience or education or both, to feel the opposite of what the crowd feels. When prices are high and everyone is buying, they feel caution. When prices are low and everyone is selling, they feel appetite. The Great Depression is the most extreme case study. In many American cities, residential real estate fell by 40 to 50% from its 1920s peak. Commercial properties in some areas traded for pennies on the dollar. The people who had cash, and in the Depression having any cash at all made you extraordinary, could buy entire city blocks for amounts that would be laughable today. Joseph Kennedy, who made his first fortune on Wall Street, used some of those proceeds to buy commercial real estate in New York City at Depression-era prices. The income from those properties funded his family for generations. His descendants are still collecting from assets he bought during one of the most frightening economic environments in American history. The 2008 financial crisis produced a smaller-scale version of the same phenomenon. Residential housing prices in markets like Phoenix, Las Vegas, and parts of Florida fell by 50% or more. Institutional investors, the big private equity firms and real estate investment trusts, moved into those markets aggressively from 2011 to 2014, buying distressed properties at prices that seemed impossibly cheap relative to their eventual rental income and appreciation. Blackstone alone acquired billions of dollars of single-family homes during that window. Those homes are now worth 2 to 3 times what Blackstone paid for them, and they generated rental income every single year in between. The crash was not a disaster for Blackstone. It was their best buying opportunity in a generation. One Reddit comment captured the ordinary person's version of this dynamic in terms that are worth sitting with. My grandfather bought his house in 1933 at the depth of the Depression. He paid $1,200 for a 4-bedroom in a city that is now one of the most expensive in America. He said nobody wanted to buy property because everyone was sure things would get worse. He bought because he needed somewhere to live, and $1,200 was all the cash he had. He became rich by accident because he was the only person willing to act when everyone else was frozen. The grandfather's story is not about sophisticated analysis. It is about the willingness to act when the crowd is frozen. He needed somewhere to live regardless of the economic environment. The crash simply meant he could buy that necessary thing at a price that would have been unimaginable 2 years earlier. The modern equivalent of that dynamic is not buying real estate at peak prices because everyone says values only go up. It is understanding that the moment of maximum pessimism about real estate, the moment when the news is worst, when banks are tightening lending, when sellers are desperate, is the moment when the decade-defining purchases become available. And having positioned yourself to act at that moment, rather than being one of the people who has to sell, the mechanism that nobody explains, why the rich get richer in every crash. There is a structural reason why wealth concentrates upward during economic downturns that goes beyond individual investment decisions, and it is worth understanding because it explains why the asset strategy works at a systemic level. In normal economic times, assets are distributed across a wide range of holders, some of whom are financially strong and some of whom are financially fragile. The fragile holders are the people who bought with debt, who hold short time horizons, or who depend on their investment income to cover current expenses. When an economic shock arrives, the fragile holders are forced to sell, not because they want to, because they have to. A family that took out a large mortgage to buy a house they could barely afford in 2006 did not sell in 2009 because they had done a sophisticated analysis of property values. They sold because they lost a job and could not make the payments. A retail investor who bought tech stocks on margin in 2000 did not sell because they correctly forecast the dot-com correction. They sold because the brokerage called and said they needed to put up more cash, or the position would be liquidated. The forced seller has no power. They cannot wait. They cannot choose the timing. They get whatever price the market offers at the moment they must transact, which is always the worst price, because everyone else who is being forced to sell at the same moment is creating the very supply pressure that depresses the price further. The wealthy investor on the other side of that transaction has no urgency. They are not leveraged. They do not need the money this year. They have been building cash precisely for this moment. They can be selective. They can wait for the price that represents genuine value rather than genuine fear. The mechanism is simple, one Reddit commenter explained in a thread about how the wealthy benefit from downturns. The rich have capital that doesn't need to work immediately. The non-rich have capital that does. A crash forces the non-rich to sell at exactly the moment when prices are lowest. The rich step in as buyers. The crash literally transfers ownership of assets from the less wealthy to the more wealthy. And then the assets appreciate again on the other side, and the gap widens. This is the mechanism behind the wealth concentration data that political commentators argue about constantly. The charts showing that the wealthy own a rising share of total national assets. Every major crash accelerates that concentration, not because the wealthy did anything illegal or even particularly clever, because they had the structural advantage of not needing to sell. The question for anyone watching this video is simple and uncomfortable. When the next crash comes, which category are you in? Are you the forced seller, the person who had to transact at the worst moment because your financial life did not have enough cushion to absorb the shock? Or are you the positioned buyer, the person who had built up the specific combination of assets and liquidity that makes a crash a buying event rather than a survival crisis? And the answer to that question is determined entirely by decisions made before the crash, not during and not after. If you enjoyed this podcast, like and subscribe so you do not miss our coming videos. Thanks for watching.